Frequency Podcast Network. Stories that matter, podcasts that resonate.
So what to do about interest rates in this economy? We're just days away from the first policy announcements of 2025 for both the Bank of Canada and the U.S. Federal Reserve. And both central banks have, shall we say, a few more variables to deal with from an economic standpoint to decide whether or not to start the year with another round of interest rate cuts. My name is Mike Eppel. Joining me from Desjardins Capital Markets is Royce Mendez, the Managing Director and Head of Macro Strategy. Hello there, Royce.
Hi, Mike.
So, when we closed out 2024, there was some discussion about, okay, what would central banks do in 2025? And then we had kind of we knew that the threat of tariffs were out there from the then incoming president, Donald Trump, now in the Oval Office. But do you think that adds to obviously the mix of decisions, the decision-making process for, let's start with the Bank of Canada and what they're going to potentially announce on Wednesday coming up?
It definitely adds another level of uncertainty for the Bank of Canada. Look, I mean, the Bank of Canada is starting with a weak economy. So I think the path for interest rate is still lower from this point on, just based on domestic challenges that we're going to face, like slowing population growth, the mortgage renewal wall, and an already elevated unemployment rate. But taking into account the fact that tariffs may be implemented as early as February 1st, the Bank of Canada wants to be in a position to support the economy. That likely means that they'll lower interest rates another 25 basis points at their next rate decision, and then communicate that they stand ready to support the economy if tariffs come into play.
Okay, so you are in the majority calling for and expecting the Bank of Canada to cut 25. The counterpoint or the counter argument I've seen is don't cut rates now, wait to actually see the tariffs take effect and then react. Because again, we don't know. Is it going to be 25%? Are they going to ratchet it up from a lower standpoint? Do we have to wait until April, for example, for something to actually happen? So is there any validity to that, you think?
Look, let's forget about tariffs for a second and just talk about the Canadian economy and what it requires in terms of interest rate policy. Looking ahead, there will be a lot of mortgages that will renew this year and next year, which were originally taken out during the very low interest rate period early on in the pandemic. That means that these households are going to face a very large payment shock. We've done some calculations, and we think that the Bank of Canada will have to take rates down to between 2 and 2.5% just to make those payments manageable for the vast majority of these mortgage holders that are going to be renewing. That's just based on domestic fundamentals. Take into account that also the population growth is set to slow very quickly this year as these new immigration targets drag on the ability of the population to grow. That's going to take the wind out of the sails of corporate revenues, government tax revenues. That's another reason probably to have easier monetary policy. So these are reasons that I don't think there's any need to wait until tariffs are actually implemented to keep lowering rates. Rates are, still somewhat higher than what I would say is a neutral interest rate setting, an interest rate setting that's neither stimulating nor restraining the economy. We're probably still a little bit restrictive. So I think there's room to cut even before we get any announcement from the U.S.
Yeah, the overnight lending rate still at 3.25% and mortgage rates higher than that. But, you raise an interesting point that you could argue that so far this year, Trump has kind of sucked all of the oxygen out of the room, and we're so hyper-focused on what might be coming from external forces that we maybe have lost sight of, households are still dealing with the same problems that they were dealing with in 2024. That really hasn't changed.
Yeah, that's exactly right. And if anything, they're going to intensify this year. We weren't at a point where there were extremely large payment shocks in 2024. A lot of the mortgages that were renewing last year were ones from 2019 before interest rates were at rock bottom. So the change in the payment wasn't as large as some of the ones we'll see this year, particularly later this year and into 2026. And so, if anything, the situation is a bit more critical in terms of getting interest rates lower to allow the economy to continue to grow and not fall into recession.
Let's look at what the U.S. Federal Reserve will do as well next Wednesday. It's one of those rare events where both the Bank of Canada and the U.S. Fed makes a policy announcement on the same day. It doesn't sound like they're going to cut interest rates in the States. Their economy's been stronger. But at the same time, at the World Economic Forum commentary from Trump, he was saying he knows more about interest rates than pretty much anybody else, which was a direct shot at Jay Powell, the head of the United States Fed. Does Powell hear any of that external noise, so to speak, or do they just say they got to do what they got to do, and the U.S. central bank is supposed to be arm's length from government sway?
Jerome Powell definitely hears it, but I think he's the type of person who's going to not only disregard that commentary, but actually push back against it, at least internally in private meetings with the president. Externally, what the Fed will do will be based on what's necessary for the economy. The Fed is an independent central bank, and that is particularly true of their monetary policy function. And they will continue to do whatever's best for the economy. And right now, it doesn't look like the U.S. economy really needs lower interest rates. So the Fed actually is in a very different position than the Bank of Canada. It can sit there and wait on the sidelines to see what the tariff policy is and actually wait to see some of the fallout from it. Obviously, I think the Bank of Canada cannot do that. I think the bank, if let's say 25% tariffs are implemented on February 1st, has to start cutting more aggressively if that happens, because the longer it waits to see the fallout, the worse it's going to be. It's going to be digging out of an even deeper hole.
Well, the discussion has been about, our theory has been that tariffs will cause inflation, and yet central banks might have to cut interest rates even in the face of rising inflation, which is going to be kind of an interesting dynamic.
Yeah, I've seen some what I would call misguided commentary that tariffs and retaliatory tariffs could raise inflation. I mean, it's true that retaliatory tariffs and maybe currency depreciation will raise prices, particularly goods prices, one time. But that's not sustainable inflation, particularly not if the unemployment rate rises even further. The underlying rate of inflation, aside from these one-time price level shift higher, would be quite weak. And so that's what the central bank is focused on. The central bank tries to look through these one-time price movements. Currency depreciation, if it depreciates 10%, goods prices might move up, but it'll only happen once, unless the currency depreciates 10% again the next year. It's the same thing with tariffs. If tariffs are raised 25% and we have retaliatory tariffs of the same magnitude, well, then prices will move up one, but you'd have to have tariffs rise another 25% next year for that to happen again. So that's the reason that central banks view this as just a one-time shock, and they look through it, and they really will be focused, particularly in Canada, on the unemployment rate, which is already very elevated.
I thought it was kind of interesting this week to watch how the markets reacted to what Trump was saying. On Monday, on Inauguration Day, there was a report about that said tariffs would be delayed. The dollar popped higher. Then Trump later that same evening said, no, I think February 1st, the dollar came back down. His speech to the World Economic Forum had all sorts of major potential headline risk for the global economy, domestic economy, talking about interest rates, talking about oil prices, talking about NATO. And yet yesterday, Thursday, the market barely moved. So is this a situation where now we're at the point where it's like, okay, there's a lot of talk, but investors and currency traders and such wait for actual actionable points before they overreact?
There's a lot going on, and there's a lot for markets to digest. I would argue that the currency market has priced in some level of tariffs being applied to Canadian exports. I would say it's about 10%. If we get 25% tariff, you're going to see the Canadian dollar depreciate further. If we end up getting no tariff, and there's some certainty about that, the Canadian dollar will appreciate. So there is something priced in to the currency market. The equity market are a bit separate. I mean, the equity markets are, I think very cautious about the prospect of tariffs. But there's also a lot of news about tech companies, about the ability of the U.S. economy to remain exceptional relative to its peer economies, for the businesses within that economy to continue to outperform businesses that operate primarily outside of the economy. And if tariffs, do reshore some activity, it would do so at the expense of other businesses in other countries, not U.S. businesses. And so all of this comes into play when the equity market is trying to figure out what's going on. What I really think we're set for is going to be no surprise. It's going to be volatility this year. One way or another, equity prices are going to be moving around a lot this year.
Well, it's and also any talk of tax cuts, both the capital gains inclusion here and in the United States, corporate, you hear that and immediately market does react.
I mean, the fiscal stimulus in the U.S. could be very meaningful, but even here, let's say that we get hit with 25% tariffs. What are the provinces and the federal government going to do? They're likely going to enact some material fiscal stimulus. So all of these things come into account when equity markets are trying to price in the risks of different policy announcements.
So next Wednesday, does Tiff Macklem focus more on the domestic economy or in his? I mean, they're giving their full guidance for the year, correct, on Wednesday. So how much? I have a sneaking suspicion it will be a lot of talk about what could be external factors hitting us.
I totally agree with you. I think they have to outline a base case scenario, one that probably doesn't include any tariff shock, but they will have to also outline some alternative scenario analysis and take a look at what would happen if, let's say, 25% tariff hit the economy. And they'll talk about the push and pull between a weaker economy and, price level shocks and all of the things that we've talked about on this podcast. I think the conclusion will be that they'll signal that they stand ready to support the economy with lower interest rates if tariffs hit in the course of the near future.
Januaries are sometimes boring. Not this year, eh, Royce?
Not at all this year.
We'll talk soon. Thank you very much, and see what the central banks do. Good stuff.
My pleasure.
That's Royce Mendez, the Managing Director and Head of Macro Strategy at Desjardins Capital Markets. Thank you for listening to In This Economy. I'm Mike Eppel. If you have any feedback, questions, or for a story idea or what have you, you can email me at mike.eppel, that's EPPEL, at rci.rogers.com. And just a reminder, you can get all of your favorite podcasts on the Seeker app. That's SEEKR. Again, thanks for listening.